Hello everybody and welcome to MD's Options Trading and welcome to this special series on option Greeks. In first session we have seen what is delta, then in next session we have seen what is gamma, then in third session theta, and this last session or in fourth session we are going to see what is Vega. So Vega is a option Greek which is related to volatility or which is related to emotions. So in order to understand the Vega first, it is necessary to understand what is meant by the volatility or the implied volatility, IV. Because most of times you might have heard about a IV factor in options trading, like IV is high, IV is low. So what is meant by IV? That we need to understand first, and based upon that we can understand what is Vega. So it's a quite simple thing. We can understand this concept of IV or Vega with some real life examples. Now, before actually talking about the options trading, let me give you one example. Take yourself back around 4 years. Now think about 2020. Try to remember that scenario. March and April 2020 during the COVID time. If you have observed or if you remember during COVID time, that is March and April 2020, the health insurance policies, the premium for all the health insurance policies and the term plan, it was increasing drastically. What was the reason behind that? If you think properly, during COVID time, which disease it was? It was the new disease. It was the only COVID disease and some of the diseases related to COVID. But other than more than 90 or 95% of the diseases which were on the planet, they were before COVID also all the diseases they were present. The diseases which are covered by the health insurance, it could be cancer, it could be malaria, it could be dengue. Likewise, the number of diseases which are covered by the health insurance policy, they were existing on this planet before COVID also. And during COVID, only one new disease, that is the COVID, it was introduced. But what happened, if you remember, during COVID, during COVID, all the people they started running behind the health insurance. Because if you understand or if you try to recall that scenario, no, at that time nobody knew what is going to happen. What is going to happen with my life? Nobody knew about that. Am I going to stay alive after a couple of months or not? Nobody knew that. So what happened? Naturally, all of the people they were running behind the health insurance policy or behind the term plan. So earlier, before COVID, whenever one health insurance agent he used to call us or promote a particular policy or insurance, we used to ignore him. But during COVID time, we tried to run behind him. So what happened because of that? All the insurance premium they increase like anything. First of all, it's a special or you can say simple demand and supply relationship. As demand is increasing, rate is increasing. Demand is decreasing, rate is decreasing. So during COVID time, the demand increased like anything. That is the first reason why premiums increased as per the demand and supply relationship. And another thing, even the health insurance companies they were not aware what is going to happen, because in order to design a particular policy even they have a calculation in their mind. Let's say for example I run one health insurance company for example, and let's say if I collect the premium from 100 people, then a kind of thumb rule which generally I know, out of the 100 people I may need to give payout, let's say for 2 people or 3 people, but for remaining 97 people whatever premium they are paying to me, that will be my profit. So that kind of a simple calculation a general company does. But during COVID time also, even those companies they did not know how much payouts we need to give. Let's say for example, if I need to give payout to 15 people or 20 people out of 100 people, then my company that will be in the loss. So fear was there in people's mind, fear was there in company's mind as well. So in order to incorporate with this fear, all these health insurance companies or term plan companies they increase their premiums, so that even if they need to give some extra premium to extra people, they should get some good premium, and automatically all the premium for the health insurance company it increase like anything. So this is called as the implied volatility. So implied volatility is directly related with the emotions of both buyers and seller. So whenever fear factor comes, no, the people they try to go for the insurance. And whenever they try to go for insurance, more and more people they are running behind the insurance, automatically its price will increase, and that is called as the implied volatility. Let me give you another example. Let's say, for example, the example which we studied yesterday about the cricketing example. For example, let's assume that cricket match is going on between India and South Africa. It's a 50 over game, and we are betting. Like I am saying that India will not score above 300. You are saying India will score above 300. And for that, it's a 50 over game. And for that, let's say I am taking 50 rupees premium from you. Now, how this 50 rupees premium is been calculated? Let's assume that there is a mathematical model or mathematical formula to calculate the premium. Let's say, for example, that mathematical machine, or you can say mathematical model or mathematical formula, it takes some inputs. What inputs it is taking? Like how many overs are remaining, how many wickets are fallen, then what is the strike price, that is what are the runs for we are betting, whether we are betting for 300 runs, 350 runs or 250 runs. So what is the strike price, how many overs are remaining, how many wickets are remaining. Likewise, that mathematical machine, it will take some input, it will churn all those input, and it will give a fair valuation or fair premium. So let's say we are betting for India South Africa match for 300 runs, and if you give all these details to that machine, then after churning that all those details, the machine will come up with 50 rupees premium. That 50 rupees premium, it's a fair value, fair value in the sense which is good for both buyer and seller. And it will say like if seller sells at 50 rupees and if buyer buys at 50 rupees, it will be a kind of fair valuation for both of them. And I will be agree and I will sell you at 50 rupees and you will buy it at 50 rupees. This is the one thing. Assume that on next day, immediately on the next day, the match is being played between India and Zimbabwe. Try to understand, huh? Yesterday the match was played between India and South Africa, and the mathematical machine, it gave the fair valuation as 50 rupees. And both of us, we agreed for that, and we did the betting. You paid 50 rupees to me as a premium. I took that premium with me and we bet and we did the betting. Today the match is between India and Zimbabwe. Same 50 overs match. And we use the same mathematical formula to put the values. The mathematical formula, it will churn all those values again, and it will give us the same result at 50 rupees. Because mathematical formula or mathematical machine does not understand whether the match is played between India or Zimbabwe or India or South Africa or Pakistan and Australia. It will take some inputs like overs remaining, wicket remaining and strike price and some other mathematical inputs it may take, and it gives you the result. Now tell me one thing, yesterday I was ready to take 50 rupees premium from you because the opponent was South Africa. I know that South African bowling attack is fantastic. So it would be difficult for India to score more than 300 runs. But today the opponent is Zimbabwe. So against Zimbabwe, even I know that it will be easy for India to score 300 runs. So will I be ready to sell that particular option at rupees 50 to you? Of course not. I will say I will need at least 70 rupees for this particular bet. I will need at least 80 rupees for this particular bet. Now the mathematical model has given the option premium, the fair premium to be 50 rupees. But here I am not ready to pay at 50 rupees. Why? Because my emotions are coming in between. My feelings are coming in between, and because of which I am demanding 80 rupees from you. And let's say you purchase at 80 rupees. Now this difference of 30 rupees, the theoretical value is 50 rupees, the practical value or the actual execution value is 80 rupees. This difference of 30 rupees, it's called as the implied volatility. This is the basic fundamental, this is the basic definition, this is the basic concept. So no need to confuse, no need to think much. This difference is called as the implied volatility. In order to understand this concept, I will give you third real life example. The reason being, what I have observed, most of the traders, even though they are trading in the stock market since last 1 year, 2 years, even they don't know the concept of IV properly. They forget about Vega. Vega, that depends upon IV. So they don't know the concept of IV first. So because of which they don't even understand what is Vega. Now, the third example. Let's say, for example, if you want to buy an apartment, then for any kind of real estate, especially for the apartment, there are two rates. The first one is the ready reckoner rate, and second one is the market rate. Now, have you ever seen, in most of the times, the deal never happens at the ready reckoner rate, because the ready reckoner rate is a rate which is, I can say, the theoretical rate, and the market rate is the actual rate at which the deal is happening. So the difference between the ready reckoner rate and market rate is called as the implied volatility, or IB. Now, if you go to well-developed cities, let's say if you go to Mumbai, Bangalore, Chennai, Delhi, Kolkata, if you go to these kind of cities now, you will find the big difference between ready reckoner rate and the market rate. High difference. And you may say their implied volatility is higher, because as these are the developed cities, the seller of the real estate, they will try to sell as expensive as possible. On the other hand, if you go to rural areas wherein there is not much development has occurred, there the seller, they will be ready to sell their real estate which is very closer to ready reckoner rate. So their implied volatility, or IB part, is minimum. The same thing or the same concept that happens in stock market as well in options trading. What happens now during the volatility? Let's say, for example, if war is happening, or election is coming, or budget is there. So in these kind of events, nobody knows what is going to happen. Let's say, for example, election is there. If the result of election is good for the market, then market will shoot up. If the result of election is not good in market point of view, then market will fall down. The similar is the case with the budget also. If the market is happy with the budget, the market will shoot up. If the market is not happy with the budget, market will fall down. So generally during event time, whether it is the positive event or negative event, market reacts violently. So if the market is reacting violently, nobody knows in which direction market is going to react. So at that time, what happens? The option buyers generally, they try to buy the insurance for their portfolio, because you must be aware, option trading has introduced in the market as a hedging purpose. It's a different story that most of the people, they use it for trading purpose, but the basic meaning of option trading is hedging. Let's say, for example, if I am holding one big portfolio of, let's say, 40 lakhs or 50 lakhs, and one big event is happening, war is happening, and let's say I am worried about my portfolio, then I will buy a put. Buying a put is same like buying an insurance. So likewise, for this particular event, if number of people that try to buy the put option, that is the insurance, or the call option for the short portfolio. So in some cases, my portfolio, it could be short portfolio as well. And for my short portfolio, I may buy hedge as call side. So if the buying is happening for both put side and call side, especially for the put side, that means demand is increasing in the market before the event. So automatically the option premiums, they will shoot up. So automatically IB will shoot up. So most of the times during the events now, the option premiums, they are shooting like anything. Okay, that I will show you with one example, with some practical example. So I will come here. This is the software, and I will show one example over here. Now I will go to 1st of March 22. I will go to 1st of March 22. Why March 22? Because I remember in March 22 it was a election for Vidhan Sabha election for 3 or 4 states, including UP and some other states. The Vidhan Sabha election was there. So due to election, the India VIX, or you can say implied volatility, it was increased like anything. So I will show you that. So I am selecting 1st of March 22 over here, and I will select the payoff as 22, that is March 22, and I am selecting the 31st March expiry, the monthly expiry, and I'm coming 5 minutes, it's 9:21. What is the spot price? Spot price is 16,607, so we can assume that is 16,600. So what I will do, I will buy one at the money call option. I will buy one at the money call option, that is 16,600. This I am buying. At what rate? 541. Similarly, I will open another window and I will go 2 years ahead. Now I will select 1st of March 24, this year, when no event was there in the month of March in this particular year 24. So I am selecting same date, 1st of March. The expiry is March, monthly expiry, and this I am selecting 28th of March. I am going 5 minutes ahead and get option chain. What is the at the money? At the money is 22,100. 22,100. So I will buy 22,100 call option. This I have bought. Now you do the comparison. Here in first case, the spot was 16,600. The Nifty price was 16,600. Still, how much premium I paid? 541 rupees due to election. And here in 2 years later, when the spot was 22,100, for 22,100, how much premium I paid? That is 427 rupees. If I take it on the calculator, I will open calculator here and I can check how much premium I had paid. Initially I paid 541 and the spot price it was 16,600 multiplied by 100. So I have paid around 3%. I have paid the 3%, as you can say, insurance amount in 2 years back, 3.25%. Now if I come here for this year, how much I have paid? 427 divided by what is the spot price? 22,100 multiplied by 100. How much I have paid? 1.93% or 2%. So you can say 2 years back during election, when I wanted to buy one call option, I had to pay 3.25% of the amount, 3.25% of what? Of spot price. And this year, when no event was there in March 24, I had to pay only 2% of the spot as a insurance amount. So isn't it a big difference? And that big difference is called as the implied volatility. So this is reflected over here. If you click the option Greeks, this is for 22. For 22, the IV was 27.85 or close to 28. And here for this year, if I click on option Greek, the IV was 14.59. Earlier, 2 years back, the IV was 28. At the money IV was 28. And this year, in the month of March, the at the money IV was 14. Almost half of that. So we can say the IV is low. That means sellers are trying to sell the option with some lesser premium. So we can say the probability of market going to be volatile is less. If IV is high, option premiums are high. That means option sellers, they are demanding extra premium from the option buyers. That means it is expected that market is going to be volatile in upcoming time. So So it could be 1 month time duration, 2 month time duration, might be. If IV is low, that means option seller, they are ready to sell the option even at the lesser price. That means the probability of market volatility is less. Now, again, one more practical example I will give you. I have opened option chain here, and in order to understand the concept well, I have selected the long dated expiry. You see here, I selected Nifty and I selected 26 December, like the expiry which will be there after 6 months or 7 months. I have selected that expiry because you will understand this concept very well for long dated expiry. Concept is same even for today's expiry, the concept it will remain same, but in order to understand the mathematical calculation well, I selected the long dated expiry. Now currently the market spot price is 22,240. It is written over here 22,240 Nifty contract, and I have selected for December 24 expiry. And if I want to buy a call option, 22,000 call option, that is the at the money. If I want to buy this 22,000 call option which is at the money, how much premium I need to pay? I need to pay 1770, that is 1,770 rupees I need to pay. Whether this is the correct premium or not, that we will check. So for that, I come over here. This is called as the Zerodha Premium Calculator. This is a free software or free calculator available. You can check it. This calculates the option premium based upon the Black and Scholes option pricing formula. So what is Black and Scholes option pricing formula? What is the mathematics behind that? You need not to go for that. Just you try to understand how the option premium they are calculated. Now, remember what I said you. For cricket match calculation, let's assume that a mathematical machine is there or mathematical model is there which collects all the data, like how many overs are remaining, how many wickets are remaining, then what is the strike price, and based upon this it will give you the result. Similarly, this is a kind of mathematical machine. This accepts the input. What input it accepts? First of all, it will ask you for the spot price. What is the spot price? Spot price we have seen, that is 22,240. I have put it over here. What is the strike price I am betting for? That is 22,000. What is the expiry? The expiry I have selected 26th of December 24. Here 26th of December 24. Same expiry I have selected. What is the time of the expiry? That is 3:30 in the afternoon. So 15:30 in the afternoon. Then dividend we need to select as 0 because for Nifty since last many years the dividend is 0. Interest is it's 10%. Why 10%? This is given in the option chain here. 10% interest rate is applied while compounding the implied volatility. So this 10% I have put over here. Initially I will select the volatility to be 0 and I will press the calculate button. So when I press the calculate button, for call option, it is giving me the premium of 1589. So what this calculator or this mathematical machine is telling, for, see, currently Nifty is trading as 22,240. I am betting for December expiry, that is 26th of December. And I am betting for 22,000 call option with 10% interest rate. These are the inputs it has taken, and with zero volatility or zero emotions, it has given the premium of 1589. Now look over here. What is the LTP? LTP is 1770, which is different from the mathematical answer. Why? Because emotions are playing. So the seller is not ready to sell exactly at the ready reckoner rate. He is demanding something more. So how much he is demanding something more, that is written in this IV part. How much this is written? This is 10.36. So let me check. If I put 10.36 value over here, can I get the same number? So here In this volatility, I will put 10.36 and I will recalculate. After recalculating, how much value I am getting? I am getting 1766. So isn't it the same value present over here? That is 1770. 4 rupees here and there. That is fine. That is very minimum difference. So 1770. This number is achieved with this much of IV, 10.36. So what I can say, this is 1589 is the ready reckoner rate, or 1589 is the mathematical rate or the theoretical rate. But currently, due to volatility or due to fear factor, when I add this fear factor, this 1766 is the market rate. This is what we can identify, or this is what we can analyze. Now, again from over here. With this, I can tell you, now we can go ahead with the Vega. Now what this Vega tells, this Vega of 2386 over here, what it tells, this much of profit I will get if this implied volatility, if you listen it carefully, currently the implied volatility of 22,100 is 14.59. That means same like here, the implied volatility is 10.36. So what it tells, it tells like the market value. What is the market value? Market value of 427 rupees is higher than the ready reckoner value. By how much? By 14.59%. I will come up again. The market value of 427 rupees is higher than the ready reckoner value or mathematical value by 14.59%. Okay, got it. Now, what this Vega tells me? This Vega tells me like, if this IV again increases by 1%, so instead of 14.59, if this becomes 15.5, if this IV increases by 1%, why? Maybe election is coming or some XYZ reason. If because of some event, if this IV increases by 1%, no, I will be getting this much of profit, 2386. Why profit? Because I have bought the option. You look over here, this is plus sign. Plus sign means I have bought the option. After buying of my option, if the IV is increasing, that means option premium, it will increase. It's a logical thing. I have bought something. After buying, if after that volatility increases, then option premium, it will increase. If option premium increases, I will be profitable. How much I will be profitable? That is given in this Vega. For every 1% increase in this IV, I will be getting 2386 rupees. Now, if I change this to seller, let's say instead of buying, I would have sold this. Instead of buying, I would have sold this, then my Vega, it would have been negative. Why negative? I sold it at 427 rupees. When I sold it at 427 rupees, the IV was 14.5. Now tomorrow if IV increases to 15.5, that means the option premium, it will increase. I sold it at this level, then it has increased, then I will be facing the losses. How much loss I will be facing? That is 2386 rupees. I will face the loss for every 1% increase in IV for this particular value. This is its calculation. So what we have seen about the delta already. This is at the money, so its delta is near to 50. Why this is negative? Because I have sold this, so this is negative. Theta also we have seen, that is the time decay. Now this is what it is telling, 638. It is telling me that if the market remains here only, if IV does not change, market remains here only, that means delta will not change. If IV does not change, that means volatility remains the constant. And if all other things are constant, then I will be getting 638 rupees in one day, because I am an option seller. Gamma is a second level option Greek. So as of now, ignore this 0.04. That is not at all required as of now. Vega, what it is telling, for every increase in IV by 1%, I will be losing 2386. What if IV will decrease? I will be profitable. If tomorrow, if this IV it becomes 13.5, I sold this option, and if it becomes 13.5, then I will gain 2386. If IV, as an option seller, if IV increases, I will lose the amount. As an option seller, if IV decreases, I will get the amount, or I will get the profit. It's a simple thing. So we have seen delta, we have seen theta, we have seen gamma, we have seen vega, and we have seen IV. So all these technical parts we have seen. Then the last part of this session, you may ask, what is the use for this in actual trading, right? So what is the use? I will tell you over here. For that, if you consider this India VIX chart. Now what is India VIX? This IV is particularly for this particular strike, that is 22,100 strike. Now what is India VIX now? For India VIX, all the IV or all the option premium of Nifty for this month and for next month expiry, they are considered, and based upon that they have got a very complicated mathematical formula. Don't go for that particular formula, and they have formed one index which is called as the India VIX. I will come up once again. This IV refers to only this 22,100 call option for March expiry. Only for this one expiry and only for this one strike price, this IV it is referring. So similarly, all the IVs of all of the strike prices for all of the expiries in the sense monthly expiry, they are combined together, they are churned together, and based upon that one single index is formed, that is called as the India VIX. So this India VIX, it will tell you about the overall volatility in the market. Now this is May month is going on, all of us we know the Lok Sabha elections are going on, so you can check how India VIX has shoot up. So India VIX has gone up due to the election, due to event. So you are fortunate that for this session actually event is going on. So this kind of volatility or increase in VIX we can see in the live market. Earlier when event was far away, the India VIX, I can say it was either stable or it was little bit reducing. It was going down little bit because not much volatility was there in the market. Now due to this election or the event, the IV has shoot up like anything. So as IV has shoot up, that means what is happening? The market is getting more and more volatile. The option premiums in the market, they are increasing. Now as a smart trader, what I can do? Remember one thing, I am not telling you the strategy. This is not the strategy class. This is a concept class. I am telling you the concept. So don't directly jump into the strategy. All the strategies we are going to cover in our strategy section. So please, only by referring to this particular concept or this particular session, do not take the trade directly. This is not a strategy class. Now what I can do, see, I am seeing this kind of increasing India VIX. By the time when election result will be out on 4th of June, today it's 8th of May, 4th of June election result will be there. So it's quite possible that till election result, this IV may reach up to this particular point, that is 25. Now, post election, 1 or day after the election, once election results are out, the market, it will react violently to that particular result. So what will happen after a couple of days post election, this IV, it will start reducing. Now the event has over, the market has formed its direction, whether the market needs to go up or whether market needs to go down or whether market needs to remain sideways, that is, we can say the compact. That decision has been already taken by the market. So what will happen? Automatically this India will start reducing. So all the option premiums, they will start melting like an ice cream. So one thing what I can do, just before the election, I will sell the options. Which option to sell, what to sell, in which expiry to sell, that I can't tell you right now because this is not a strategy session. I can give you just one hint. I will try to sell the options for the far away expiry. for December expiry or for next year expiry. This is what I will try. And I will buy the hedges for the weekly contract. What I can do, I will sell the options at the 6 monthly expiry, 8 monthly expiry, and I will buy the hedges for immediately next weekly expiry, not even monthly expiry, weekly expiry. And when this IV part or the India VIX part, it will start reducing now, automatically the option premiums which I have sold for far monthly expiry, they will start melting like anything. And for the current weekly, for which the expiry will be there today or tomorrow, for them not much impact it will be there, because already their option premiums, they have decreased due to theta decay. You can refer to my theta decay session before this. And because of which, what will happen now, this decrease in IV or decrease in India VIX, that will help me out, and that will help me to get the good profit. This is the one strategy. Otherwise, somewhere over here, before the event, I know that the IV is going to increase. At that time, I will not do the option selling. Either I will do the option buying here. Whenever I know that IV is going to increase, India VIX is going to increase, either I will do the option buying, or I will deploy the calendar spread over here. Where? Here. What is calendar spread? I will explain you in the strategy part. Either I will do the option buying or I will deploy the calendar spread. So whenever this IV or India VIX, it will shoot up, my calendar, it will give me the fantastic profit irrespective of the market move. Whether market will go up or whether market will go down, I will not care about that. My calendar, it will give me the fantastic profit. And my calendar, I have already deployed the calendar that is running, and that is giving me the fantastic profit. And this calendar, I will exit over here on 4th of June or before 4th of June. Okay. And 4th of June, I will do the reverse trading. I will sell the options in long-term expiry and I will buy the options in near expiry. So if VIX is crashing, it will give me the profit. So remember one thing, here I am not trading on Nifty chart, I am trading on India VIX chart. I don't know whether Nifty will go up or Nifty will go down. I don't know that. But one thing I surely know, during event India VIX go up. This is for sure. And post event India VIX, it will collapse. This is also sure. So I am doing the betting on India VIX. I am not doing the betting on Nifty chart. This is a smart work, and this is you can say this is most of the people, they trade likewise. So this was for the Vega. So I have covered all the option Greeks. I have covered Delta, Gamma, Theta and Vega in great details. Whatever I could have covered, I have covered all these things. I know that my sessions are a bit of extra duration. They are a bit lengthy session, but I try to cover almost all the concept or maximum knowledge I try to give in my session. In next session, it will be a very small session about row. I will explain the concept of row in the next session. So till then, thank you for watching this video. Thank you. Happy trading and have a nice time.